This is a Goldman Sachs research report, dated October 15th, 2025, just over 3 months ago. The report is titled, Precious Metals Outlook, Headwinds Persist. Page 1 contains the summary recommendation. We maintain our 12-month gold price target of $2,200 per ounce, reflecting continued pressure from elevated real interest rates and dollar strength. We recommend underweight positioning in precious metals across balanced portfolios. Underweight, sell, get out. That was Goldman's public position 3 months ago, distributed to thousands of institutional clients, quoted in financial media, used by wealth managers to justify keeping client money away from gold and silver. Now look at this, a different document, not a research report, an internal strategy memo dated January 22, 2026, 6 days ago, distributed to Goldman's commodities trading desk and senior partners only. Classification, internal use only, not for client distribution. Page 1, first paragraph. Effective immediately, the Commodities Principal Strategies Group will initiate accumulation of physical precious metals exposure targeting 2.4 million ounces gold equivalent across allocated accounts, with secondary exposure through mining equities and streaming royalty positions. Target completion, Q1 2026. 2.4 million ounces. At current prices, approximately $6.4 billion. Not paper, not futures, not ETF shares. Physical precious metals in allocated accounts, specific bars, serial numbers, segregated storage. Goldman Sachs told clients to sell gold at $2,200. Goldman Sachs is now buying gold at $2,680. The gap between what they said and what they're doing is not hypocrisy, it's strategy. And the document that reveals this strategy, leaked to financial researchers through channels that will likely trigger internal investigations and possibly criminal referrals, tells us exactly why the most sophisticated trading operation on Wall Street just switched sides. They see something coming. Something that makes $6.4 billion in physical accumulation not just prudent, but urgent. Here's what they're not telling you. The leaked memo, 47 pages in total, now circulating among a small number of analysts and journalists, contains Goldman's internal assessment of precious metals markets that directly contradicts their published research. Page 7, under Supply-Demand Dynamics, Internal Assessment. Public-facing models understate physical demand by approximately 340 metric tons annually due to incomplete capture of central bank purchases through non-reported channels. Adjusted models suggest structural deficit of 400 to 600 tons per annum beginning Q2 2026, assuming current production trajectories. Goldman's public research says supply and demand are balanced. Goldman's internal analysis says a 400 to 600 ton annual deficit is emerging, a shortage that represents roughly 12 to 18% of annual mine production. Page 12, under Price Implications. Internal models suggest fair value range of $3,400 to $3,800 per ounce under deficit scenario assumptions. Current spot pricing reflects approximately 25 to 30% discount to fundamental value, creating asymmetric return profile favoring physical accumulation. $3,400 to $3,800. That's Goldman's private view of gold's fair value. While they publicly maintained a $2,200 target, their internal models showed $3,400 minimum. The gap is not an error. The gap is intentional. Page 23 explains why. Premature public revision of price targets risks accelerating retail and institutional demand before principal strategies positioning is complete. Recommend maintaining current published outlook until Q2 2026, allowing 90-day accumulation window. They kept the public target low to suppress demand while they accumulated. They will raise the target after their position is built. Their clients will buy at $3,400 what Goldman bought at $2,680, a $720 per ounce transfer of wealth from client accounts to Goldman's principal trading book. This is not conspiracy theory. This is the documented internal strategy of the most influential investment bank in the world, captured in their own words, in their own memo, leaked by someone who apparently decided the public deserved to know. This is where the lie becomes unsustainable. The paper versus physical distinction runs through Goldman's internal strategy like a structural beam. The memo explicitly distinguishes between synthetic exposure, futures, ETFs, derivatives, and physical accumulation, allocated metal in segregated storage. Page 31, under Execution Strategy. Synthetic exposure carries unacceptable counterparty and settlement risk under stressed scenarios. Principal accumulation must prioritize physical delivery and allocated storage through LBMA-approved vaults in Zurich and Singapore. London storage to be avoided due to elevated rehypothecation risk in current market structure. Goldman is avoiding London, the center of global gold trading, the LBMA market that sets benchmark prices, the deepest liquidity pool on Earth. Goldman's commodities desk is deliberately storing metal elsewhere because they assess London's rehypothecation practices as risky. Rehypothecation means using the same gold as collateral for multiple obligations. Bank A deposits gold with Bank B. Bank B uses that gold as collateral for a loan from Bank C. Bank C uses the claim as collateral for a derivative with Bank D. The same physical metal backs multiple paper claims, a leverage structure that functions until someone demands actual delivery. Goldman's internal assessment. London's rehypothecation has created elevated settlement risk. Their response? Avoid London. Take delivery elsewhere. Ensure their metal is not encumbered by claims they don't control. If Goldman Sachs, with better information, better models, better access than any other market participant, is avoiding London settlement, what does that tell you about the stability of the paper gold market centered there? The memo's analysis of paper physical divergence is explicit. Page 34. Current COMEX leverage ratios exceed 120-to-1 paper claims to registered inventory. LBMA unallocated claims estimated at 150-to-1 against available float. Under stress scenarios involving 3 to 5% conversion demand, settlement system faces high probability of failure cascade requiring force majeure declaration or cash settlement at prices significantly divergent from spot. 150-to-1. Goldman's internal estimate of paper claims against actual metal in London. And their response to this leverage is not to trade the paper, it's to avoid it entirely and accumulate physical metal in jurisdictions where they control custody. The divergence between paper price and physical price that retail investors discuss theoretically is a documented risk factor in Goldman's internal strategy documents. They're not speculating about divergence, they're positioning for it. When institutions do what they're doing now, they're not hedging, they're preparing for a market structure they expect to fail. The timing of Goldman's strategy shift is not arbitrary. The memo references specific catalysts that Goldman's analysts expect to trigger the physical shortage their models predict. Page 19, under Catalyst Timeline. Primary catalyst, Basel III NSFR full implementation February 2026, eliminating regulatory arbitrage favoring unallocated positions. Secondary catalyst, BRICS settlement mechanism operational testing Q2 2026, creating non-dollar physical demand channel. Tertiary catalyst, anticipated Chinese strategic reserve disclosure, estimated holdings 2x to 3x official figures. 3 specific events, 3 specific timeframes, each one a trigger that Goldman expects to accelerate the supply-demand imbalance their models show. Basel III's net stable funding requirement, which we've discussed in previous analyses, makes holding paper gold as expensive as holding physical gold for major banks. Goldman's memo confirms this regulatory change is driving their strategy. When paper gold loses its cost advantage, institutions holding paper will seek to convert to physical. The conversion demand will exceed available supply. The BRICS settlement mechanism, gold-backed payment infrastructure for non-dollar trade, creates structural demand that didn't exist previously. Goldman's analysts estimate this mechanism could absorb 200 to 400 tons annually once operational, demand that flows entirely outside Western price discovery. China's strategic reserve disclosure, the possibility that Beijing announces gold holdings far exceeding official figures, would reset market expectations overnight. Goldman's internal estimate, China holds between 5,000 and 8,000 tons, versus the official 2,264 tons reported to the IMF. Disclosure would reveal years of stealth accumulation and validate the thesis that physical gold is more scarce than paper markets reflect. Less than 3 weeks remain before the Basel III deadline, less than 4 months before BRICS settlement testing begins. The catalyst timeline Goldman identified is not distant, it's immediate. The leaked memo's accumulation target, 2.4 million ounces by end of Q1, makes sense against this timeline. They need the position built before the catalysts hit. Every day of delay is a day closer to the events that make accumulation more difficult and more expensive. At 2:30 a.m. Eastern on January 24th, 2 days after the memo's date, COMEX warehouse reports showed a withdrawal of 147,000 ounces from registered gold inventory. The withdrawal was attributed to house account transfer, internal bank movement rather than client delivery. The size and timing match Goldman's accumulation parameters. They're not just planning, they're executing. While Goldman accumulates, the public narrative remains unchanged. On January 25th, 3 days after the internal memo, Goldman's public-facing commodities team published their weekly research note. The note maintained the $2,200 price target. It reiterated the underweight recommendation. It cited the same headwinds, interest rates, dollar strength, that the internal memo explicitly identifies as unlikely to persist beyond Q2 under current fiscal trajectory. The public note and the internal memo are not reconcilable. They represent two completely different views of the gold market, one for clients, one for Goldman's own book. The dissonance is not accidental. The memo explicitly addresses it. Page 41. Maintenance of divergent public positioning serves dual purpose. 1. Suppresses competitive accumulation pressure during principal strategy's build phase. 2. Provides plausible basis for subsequent target revision without acknowledging prior strategic positioning. They're keeping the public target low so competitors don't bid against them. They'll raise the target later and claim new information justified the change, never acknowledging they saw $3,400 while publishing $2,200. The question is not whether this behavior is ethical. The question is what it tells you about where gold is going. Goldman Sachs employs over 400 commodities analysts and traders. They have better data, better models, better access to physical market flows than any retail investor or independent analyst could hope to achieve. When their internal assessment diverges this dramatically from public positioning, the internal assessment is the one that matters. They see $3,400 to $3,800. They see structural deficit. They see settlement risk in paper markets. They see catalysts hitting within months. And they're responding by accumulating 2.4 million ounces of physical metal while telling the public to sell. The information asymmetry is the tell. Goldman trades on information advantages. When their private view and public view diverge this completely, the private view reflects what they actually believe, and the public view reflects what they want others to believe. What they want others to believe keeps prices low while they accumulate. What they actually believe drives $6.4 billion in physical acquisition. The BRICS dimension compounds the urgency. Page 27 of the memo addresses geopolitical positioning. Western institutional positioning in physical gold has declined 23% since 2020, while Eastern sovereign and institutional holdings have increased an estimated 47%. The geographic transfer of physical metal creates structural supply constraints in Western markets independent of price movement. The gold is moving east. Goldman's memo quantifies what observers have noted qualitatively. Physical metal is flowing out of Western vaults, out of LBMA and COMEX warehouses, into Shanghai, Singapore, Dubai, and Moscow. The flow is one-directional. The metal that leaves doesn't return. Goldman's response to this flow is not to fight it. It's to position ahead of it. Accumulate physical metal now, before the Eastern demand wave prices Western institutions out entirely. The memo references specific intelligence, redacted in the leaked version, but clearly from sovereign sources, suggesting Chinese accumulation will accelerate dramatically in Q2 2026. The phrase, pre-announcement positioning, appears twice, implying Goldman expects Beijing to reveal holdings that shock markets. If China announces holdings of 6,000 or 8,000 tons, as Goldman's internal estimates suggest, the market's understanding of global gold distribution changes instantly. The West's paper leverage structure would be exposed against Eastern physical holdings that dwarf Western inventory. Goldman is positioning before that exposure. Their clients will learn about it after. This is what a system looks like when insiders prepare for what outsiders don't see coming. The leaked memo is not supposed to exist in public hands. Someone inside Goldman, someone with access to Principal Strategies communications, decided that the gap between public and private positioning had become too egregious to maintain in good conscience. That person took considerable risk. Internal document leaks trigger SEC investigations, FBI involvement, career destruction. The source, if identified, faces legal consequences that will last decades. They leaked anyway. The question is why? Perhaps they believed the public deserved to know that the advice they receive from Wall Street's most prestigious institution is designed to benefit Goldman at their expense. Perhaps they understood that the coming market dislocation, the one Goldman is positioning for, will harm retail investors who followed the public recommendation to sell. Perhaps they simply couldn't stomach watching any longer. The trap has no escape for those who follow public guidance. Goldman's clients, trusting the published research, are underweight precious metals at exactly the moment Goldman's internal analysis says to be maximally long. When prices move, when the $3,400, $3,800 target becomes visible to everyone, those clients will buy what Goldman already owns, at prices Goldman's accumulation helped establish. The wealth transfer is built into the strategy. It's not a side effect, it's the mechanism. The divergence between Goldman's words and Goldman's actions is the purest signal available. Words are cheap. Positions are expensive. When a bank puts $6.4 billion behind a view they're publicly denying, the $6.4 billion is the truth. The truth says gold is going dramatically higher. The truth says paper markets carry settlement risk. The truth says physical accumulation is urgent. The truth says the catalysts are months away, not years. Goldman wrote this truth down in a memo never intended for public distribution. Now the truth is distributed anyway. Those who understand what the memo reveals will position accordingly. They'll accumulate physical metal while prices reflect Goldman's public target rather than Goldman's private model. They'll avoid paper structures that Goldman's own analysts flag as risky. They'll front-run the announcement Goldman is planning, the target revision that will come in Q2 after their position is built. Those who don't understand, who trust the public research, who believe the published targets, who assume Wall Street's advice serves client interests, will provide the exit liquidity when Goldman decides to sell. The memo makes the game explicit. The game has always existed. Now it's documented. Reality asserts itself when the accumulation completes and the narrative shifts. Goldman will raise their target. They'll cite new data, changed conditions, updated models. They'll never acknowledge the internal memo, the 90-day accumulation window, the deliberate suppression of public estimates. But the memo exists. The strategy is documented. The positions are being built right now, in real time, with urgency that contradicts every word of public guidance. They switched sides. The most important trading desk in global finance looked at their models, looked at the catalyst timeline, looked at the paper physical structure, and concluded that being long physical gold is the only rational position. They're just not telling you until they're done buying. The leaked documents say $3,400 to $3,800. The leaked documents say 400 to 600 ton deficit. The leaked documents say settlement risk at 150 to 1 leverage. The leaked documents say accumulate now, before Q2, before the world understands what Goldman already knows. The documents were never supposed to be public. Now they are. What you do with that information is the only variable Goldman doesn't control. Their position is being built. Their timeline is Q1. Their catalyst is weeks away. The memo exists. The accumulation is happening. The switch is real. The question is whether you understand what Goldman's switch means before their public announcement makes it obvious to everyone. By then, the accumulation window will be closed. Goldman's will be built. And the prices that seem high today will seem like the opportunity that most people missed. That's not a prediction. That's what the leaked documents say. In Goldman's own words, in their own internal strategy. They switch sides. Now you know.